there was a secret report by the RCMP that said they were preparing for civil unrest.
Just it kind of all fits within, as you and I've talked about before, this Neil House fourth turning is here thesis. And the fourth turning is a mega crisis that comes along about once every 80, 90 years. So if that's happening, and I think it is, and I think all you'd have to do is just look around each day to see this major, kind of crescendo of problems that are hitting us.
David Hay returns to the show. He is a co-CIO of Evergreen Gavekal, a diversified fund that manages over $4 billion in assets. We'll be talking about David's updated views on what he believes is the biggest bubble right now, bubble 3.5, as he likes to call it. We'll be talking about David's views on inflation, macro data that could suggest a soft landing is no longer in the works. And we'll be talking about the deterioration of Canada and the US and what he believes are the biggest news events driving markets right now and the assets he likes the best right now. Speaking of events, this episode is sponsored by Kalshi, a trading platform, very interesting trading platform that allows you to trade on events directly. Stay tuned for a message on how that works exactly. David, welcome back to the show. Good to see you.
Thank you, David. It's a pleasure to be here. And I can see you got another lovely late May day in Vancouver in the background there.
Well, talking to great people like you makes up for the bad weather. So I enjoy being inside on days when you're on the show, David. Let's talk about asset allocation today and what you like and your outlook for the economy. Let's start with this then. What assets, if any, do you prefer right now to overweight?
Well, we have liked hard assets a lot. And we've talked about that in prior chats, including the one that we did in April with my partner and great friend Louis Gobb. And one of the things that I talked about at the time, which was extremely out of favor, was gold miners, was and is gold miners, which have really come alive. In fact, hardly anybody knows they've like doubled the return of the S&P this year. So they are starting to kick into gear. I think they've got a lot further to go. I think that's true of commodities in general. If you looked at a chart of commodities versus tech, it looked just like 1999, early 2000 here recently. Now, tech has been kind of flatlining a bit, not going down, but going up, and the commodities have come on. And I would caution that, there's a lot of breakouts happening in the commodity complex. Look at copper, look at gold. We flagged that huge breakout in gold that happened earlier this year. But it's discontinuous. There are other commodities which appear to be breaking downtrends. In general, the commodity complex has been on its heels since early 2022 after the Ukraine invasion, but that downtrend is clearly being broken. So I think it's a matter of being careful and judicious. And frankly, since you brought that up, one of my favorite new hard asset plays is palladium. And I would caution it to run a little bit here lately, but I think it's a very interesting story and it goes way beyond palladium. It gets this whole thing about EVs. And frankly, I think EVs are becoming increasingly disappointing. And I think that's going to be a persistent trend in the years to come. But from the standpoint of good for the environment, I think what's happening with hybrids is very, very encouraging. I think that's where you're going to see the really rapid growth. And the reason I bring that up in terms of palladium is not used in EVs, but it actually is, there's about 10 to 15% more usage of palladium in hybrids than even in internal combustion engine autos. And if you look at a company like BYD, the biggest automaker in China, and by the way, as you probably know, China is now the largest auto exporter in the world from, like a non-player a few years ago. And BYD is now seeing their hybrid growth at over 80%, whereas their EV growth is about 20%, which is, still respectable. But I do think the world is pivoting towards hybrids. I think it's vindicating Toyota's stance on this. So I think that's a trend that's got, really strong legs.
Palladium and platinum have both run up considerably over the last month, pretty much in tandem. Was there a particular news event that presented this catalyst?
I think there's more coverage of this starting to occur. I know that Louis Gobb has been writing on this. He's a very strong believer in what I just said. Trader Ferg, who's a guy that I follow, a Kiwi, very bright, and then up in your country, Kevin Muir from the Macro Tourist. So I think there is attention being focused on that, but I'd also say it's probably just a general uplift from this commodity rally that we've seen. One thing I guess I would point out about that is with these, it's surprising to a lot of professional investors that commodities and look at gold is doing so well with as significant a real interest rate as you have in the U.S. That was not supposed to happen. But I think what the market is starting to realize is that the Fed is going to have to cut at some point here. They clearly wanted to cut. And so you just start visualizing what's going to happen to these hard assets once the Fed goes into easing mode. And maybe that's a good segue into just kind of where the economy stands and how likely that is. As you know, at the beginning of the year, there were 7 rate cuts factored in at one time. And, I thought that was nuts and wrote about that at the time. Now it's one, but, and I think it's going to be tricky if inflation is the rationale for the easing cycle, because inflation is proving sticky. I mean, if you look at the super core X housing, it's running at about 6.5% on a 6 months annualized basis. There's been that my thesis, which we talked about earlier, of stagflation, seems to be more accurate or more validated. Of course, Jay Powell is discounting that, but his track record is not so great. But I do think that we have the situation where if the Fed's going to be cutting, it's not going to be because of inflation. It's going to be because the jobs market falls out of bed. And I think there's more and more evidence that the jobs market is deteriorating. And the history of that, when it starts to go south, it goes south really quickly. And I think that could be the big surprise over the next few months. And if that happens, then I think you could expect a series of rate cuts, even this summer, which the Fed really doesn't want to do. They don't want to look political. There's a lot of people think that Jay Powell doesn't want to see the orange swan back in the White House, and that he'll do all he can to get Biden reelected. I think it's more true of Janet Yellen, by the way, but so I think they just don't want to look political. But if the jobs market deteriorates rapidly enough, they may have to.
Before we continue with the program, I want to tell you about today's sponsor, Kalshi, which has a very interesting platform that allows you to trade events. That's right, events. Now, on this show, we cover a lot of important macro events such as geopolitical tensions, mergers and acquisitions, economic data, so on and so forth. But as retail investors and traders, how do we or you directly trade on these events? Kalshi is the first U.S. regulated exchange which allows you to trade on these events. Just like how you trade stocks on the NASDAQ or NYSE, you can now trade events directly on Kalshi. The exchange already has hundreds of thousands of users and has seen more than $500 million in transactions. Here's how it works. Let's say you think that house prices won't rise this year or even crash. Well, currently, this bet is trading for 9 cents per share, but if you buy 1,000 shares for $90 and home prices do not rise, then you will earn $1,000, a more than 10x return on this bet. You can also choose to bet that house prices will rise, and you can even bet how high they will rise. Whether it's politics, markets, or even the weather, you can bet on whatever you're interested in at Kalshi. And the first 500 traders who sign up for Kalshi and deposit $50 using the link below, kalshi.com/davidlin, or on the QR code here, will get a free $20 credit. Join Kalshi and start trading today. Well, you wrote to me to note that you still don't believe in the soft landing narrative, which you just talked about. But I'm looking at a lot of these metals that are base metals, industrial metals, and they've been surging. I don't know if that's an indication of future economic strength or at least expectations for economic strength. Certainly copper. If you take a look at copper hitting new all-time highs this week, I'll just read you a paragraph from this Bloomberg article. Copper surged to its highest ever level, extending a months-long rally driven by financial investors who've piled into the market in anticipation of deepening supply shortages. Now, I'm not sure if these shortages are coming from disruptions in the supply chain or mining, or whatever the case may be, or shortages because there's going to be a huge excess demand later on. What's the story, you think?
Well, I think it's kind of all of the above. I mean, it's very difficult to build a copper mine. And even in countries like Chile, which have historically been easier to do development, are becoming much more hostile to it. So it's, in fact, the CEO of Freeport was just on CNBC today talking about this acute problem, this shortfall of supply and this booming demand. And that's always been one of the real problems with the great green energy transition, why I thought it was so inflationary, is that the demand for these critical components, is going up at a much faster rate than the supply. In some cases, supply is actually going down. So it's a huge collision. I think that's another reason, by the way, why we're probably going to see more of a shift to hybrids, where you don't have to have some of those, quite so much copper, quite so much cobalt, quite so much nickel. And then, of course, there's the grid, which is a whole other story. But of course, what's entering into that calculus is AI and these data centers, which are just energy hogs, electricity hogs. So that's going to put even more pressure on the grid. So you think about, okay, well, we're going to add millions of additional EVs to the grid. At the same time, there's all this pressure coming from the data center build out for AI. I mean, you could have widespread grid failure in the US, and there's ways to play that. But once again, I think it just loops back to the fact that policymakers are going to wake up and say, hey, we're not going to push EVs, we're going to push hybrids. So I think you really want to be looking for ways to benefit from that trend.
So hybrids, what are the metals or commodities that are required to play the hybrid narrative?
Well, like I said, I think palladium was one of the obvious ones. And the reason that's so interesting, and rhodium, by the way, too, is that the consensus belief is there's going to be shrinking demand because at this point, what I'm talking about with the shift from EVs to hybrids is a very non-consensus, off the radar type of view. So the market is positioned for EVs to continue to grow exponentially. But they still hybrids do require they have batteries. The batteries are a lot lighter, so maybe you're going to get a resurgence in demand for lithium, and there's still going to be pretty decent demand for copper from hybrids, but not nearly to the degree with EVs. And so maybe that's going to help alleviate this copper shortage because it does look very, very scary. And that's something that Jeff Curry, the former Goldman Sachs commodity strategist, has been pounding on for a couple of years. But yeah, I mean, as you know, we've been big fans of copper, particularly Freeport.
Do you think it has more room to run past $5 already a pound?
Yeah, I think so, but I would just caution, and just like I would with Freeport, it's an impressive breakout that it's made here recently. As you're aware, we're big believers in multi-year breakouts, multi-year being at least 3 years. Breakouts to all-time highs are even more impressive. And, as you pointed out, that's what's happened to copper recently, but it's extended. And I think that's where you have to be careful. People get all caught up in the momentum and the euphoria, and they buy it kind of high and it pulls back and they go, oh my gosh, I'm on out. This is not working. People's patience with underperforming assets these days is so short, and you can get blown out of a good long-term position because it's just correcting in a big uptrend. So I would just recommend with these things that have really appreciated significantly lately to put on a partial position. If you're not in there at all, just put on a little and kind of double try to dollar cost average.
Right. So let's talk about the labor market. You mentioned that's one of the areas of the economy that's seeing signs of weakness. So two data points I want to bring to your attention. First, non-farm payrolls from April came in much weaker than March. So April added 175,000 jobs. March was 215,000. And of course, as you know, the unemployment rate continues to tick up ever so slightly. Why the slight deterioration in the labor market that we've seen, at least on the surface?
Well, I think the reason that it's slight is because of these unreliable government statistics. I think that the deterioration is much more than slight. If for one thing, the response rates are way down from pre-COVID. I think they're running at about 40% on the non-farm payroll surveys. Was over 60% before COVID. So that's one problem. But the other really big problem is the birth death model. I know you've talked about this with other guests. And so what it basically does is it tries to assume, the job creation due to new business formations. And in normal times, that's fine. But when the economy is turning down, and I know that's arguable, but certainly what's inarguable is how many businesses are failing. I mean, front page of the Journal today, Red Lobster, going into bankruptcy. There's a lot of businesses that are really struggling with these higher interest rates that are hitting with a lagged effect. Now, there's a lot of businesses that are doing great because of the higher rates. So it's really a tale of two economies. But I would say the proof beyond the birth death model and its built-in distortions at times when the economy is decelerating, just look at the revisions. So they report these jobs numbers and people get really excited about a big print. And then they go back and they drastically cut them, in hindsight and retrospectively, and there's no focus on that. And yet that's been the trend for over a year, just this consistent downward revision trend, and it's still going on. And the other thing that's been very clear is that the jobs that are being created tend to be part-time versus full-time.
Yeah. It seems to me that the larger tech companies continue to see profit surges, while a lot of these other companies, you mentioned Red Lobster going bankrupt. I'm very disappointed, by the way. As a Canadian, I've never tried Red Lobster, and I was hoping I would one day. I'll never get that chance. But anyway, my point being, it seems to
You're not going to get the all-you-can-eat shrimp, I guess, because that's one of the things that apparently sunk them. But
I don't know.
I mean, it's not just them.
Yeah.
Sorry?
I don't know. There's a liquidation sale going on over there, but I'll go down as that. But yeah, my point is there seems to be a bifurcation of the economy from an investor standpoint. Would you be piling in more money into the large cap S&P 500 companies and away from the smaller cap companies because some of these other companies in the other sectors are lagging?
Well, I think you just have to be very careful because some small cap companies have fortress balance sheets. Some large companies don't. They have a lot of debt. So I think it's important to drill down and look at, what their specific financial profile is like. But, to your point, it's not just Red Lobster. I mean, look at these companies that just disappointed: Starbucks, McDonald's, Yum Brands, Tyson's, Disney, Home Depot. I mean, these are some really elite companies. So it's I think there are problems showing up, but I will say that I did shift out of the hard landing camp back, I don't know, 8 months ago, because of the explosion in the federal deficit. I mean, I think that's why we talked about this before. We didn't have a recession last year as the federal deficit went from a trillion to 2 trillion, just enormous stimulus. And frankly, a big part of that is what's happening to interest rates. So there's a huge transfer going on. And instead of government stimmy checks like during COVID or right after, you've got this tremendous increase in interest income going to the wealthy companies, wealthy consumers. So there's a lot of money that's being dumped into the economy, but instead of hitting at the lower level, which it did after COVID, it's hitting, making the rich richer and making this wealth gap and income gap even greater, which is frankly the last thing we need right now. So I've been really saying repeatedly, it's hard to have a recession when you're running $2 trillion federal deficits. But, you could argue, and I know like Danielle DiMartino Booth is very adamant about this, that it's the delta, the rate of change that matters. So you're not going to double the federal deficit this year. Maybe it's going to be just about flat. So
Yeah.
it's not going to create the incremental stimulus that it did last year. And I think that's a very good point.
And I think Evergreen Gavekal, I think, has over $4 billion AUM, correct?
4.7.
4.7. Is this a difficult time to allocate or decide on asset allocation for you, given that a lot of assets are moving up together in tandem? You've got stock markets breaking up to new all-time highs, right? We've talked about copper and some of the other base metals. Gold continues to break new all-time highs. The dollar isn't collapsing; it's still, relatively strong. And yields are the 10-year is still above 4.5, not quite at 5%, but it just seems like a lot of assets are moving up in tandem together. How do you decide then? What's your process on how to decide to allocate assets?
Well, you're exactly right. And so it's very different than it was a few months ago when there were a lot of laggards out there. And there were a number of, stocks and asset classes or sectors that were breaking out of multi-year trading ranges, which again, we love. But a lot of those have run. So it is more challenging to put capital to work at this point. One area which has not run very much and which I think is off the radar of almost all Western investors to their detriment, in my opinion, is emerging market debt. And emerging market debt has crushed the treasury bond market over the last 4 years, which has been, I think, the worst bear market. The long-term treasury return since the summer 2020 is minus 40%. Then think about it in real terms. And emerging market debt has had some negative returns, but very modest in that period of time. So they have held up much better. And if we're going to go into a global interest rate cutting cycle, which we very well could, there's, I think, pretty good evidence of that. These emerging market countries, which even Jay Powell was saying this here the other day, that these guys are not, they're not your father's emerging markets anymore. In many cases, they're operating with better fiscal and monetary policies than the U.S. And you look at Brazil, where their 10-year government bond is still yielding over 10, and inflation's about 5 or 4. So you've got a really significant real yield after inflation. And that's true of a lot of these emerging markets. The stronger, some are terrible. You don't want to buy Turkey, probably don't want to buy South Africa, but Indonesia, India, there's a number of Mexico, there's a number of these emerging markets that actually look quite attractive for bonds. And that just doesn't seem to be in the playbook of hardly anybody. And what we're seeing is that some of these, like if you look at Morgan Stanley's emerging market fund, EDD, really looks to be on the cusp of breaking a long downtrend. And so that's another thing we like to see where, something's been in a consistent downtrend and it starts to break above that. That can be a very lucrative place to put capital. But you're right. In general, I think you got to be a lot more selective right now, be willing to hold some cash. But I do worry that you got a lot of people who are overdoing the T-bill and chill thing. where they're saying, look, I can get, over 5% with a T-bill. I'm not going to buy anything else.
Hmm.
But if this economy is rolling over and the jobs market is really going to start to struggle, man, those rates can come down in a heartbeat. So I think
That's
it is important to lock in yield.
uh well, you are bullish on inflation, meaning you do see a second wave of inflation coming. We'll talk about inflation next. Why would the long end of the yield curve come down if inflation expectations remain high?
Well, first of all, I'd say that's happened. I mean, it's not, that's what I was speculating on or opponing on back in the fall, is that I thought we would get kind of sticky inflation, another pop in inflation, another pop in rates. I mean, we had the 10-year that got down to what, a 380 late last year. Then it went from 380 to 470. So, I mean, we got a major spike back in rates. We've seen that inflation come back up. I think going forward, we might actually see some easing, a cyclical easing pressure on inflation because of the economy starting to suck wind. I think it's going to be transitory, to use that famous word. And one of the reasons I do is I believe that the policy response to any recession is going to be very inflationary. So this is, I would say, looking at treasuries right now, and we're kind of too chicken to go out with really long treasuries. We're doing more of the intermediate kind of 5 to 7 years where you lock in yield, but you're not too exposed to duration risk and hopefully can pivot. Because I think there's going to be a time where you do need to pivot and expect, another spike in inflation. I think that a lot of these inflation forcings, if you will, are persistent, not transitory. And things like the great green energy transition, which is quite inflationary, the reindustrialization of America, these trade wars that are going on and intensifying. We're trying to, and I think we're waking up. We see the war in Ukraine, and we're really depleting our military stockpiles and how reliant we are for a lot of our critical materials on China. So if we're going to try to be self-sufficient, I mean, that's just like with semiconductors. You build these plants over here in the U.S., and they're just a heck of a lot more expensive to run than they are in Taiwan. So I think it's, again, there's the short term, kind of the cyclical downward pressures on inflation, which I think will manifest here for a while. But I think it's going to be a tight window. I think it's a tight window to play a treasury bond rally. And it's probably something that you don't want to do as an amateur. I don't think there's going to be very much time, frankly, to benefit. But I do worry that people are kind of complacent with these 5% T-bill rates.
Okay, I'm gonna throw a wild card at you here, now, David. I read
Go right
recently
ahead.
that Ray Dalio is suggesting investors move funds out of the U.S., and he listed a number of countries that he thinks are better places. His reasoning is that there is a higher than 30% chance of a civil war in the U.S. For political reasons. And he doesn't think all of the U.S. capital markets is bad. There's pockets of strength, but overall, he's suggesting move money out of the U.S. Right? What's your response to this?
I'm right there with him. In fact, I was going to bring this up. Let's talk about your country for a second, because it might go this way first because of, Canada, I think is going down, economically quicker than the US. And so we were talking about this before we started recording. If you look at gross GDP, it doesn't look too bad, but you guys have had a big immigration influx, legal in your case versus our illegal immigration influx. So it creates this artificial boost to GDP. But in Canada, per capita GDP is down 6 straight quarters. That's not good. And you've got, of course, you had a bigger housing bubble than we had. You got a lot of variable rate debt, unlike what we have. I think you got a lot of your consumers up there that are really in trouble, and they're starting to get restless. And apparently, I don't know if you saw this, that I got this from a very good source, Adam Taggart, that the Royal Canadian Mounted Police has a document got leaked from them that they're preparing for really intense societal strife,
Yeah,
almost a revolution.
that was a report that was released not too long ago. There was somebody filed a access to information request, and there was a secret report by the RCMP that said they were preparing for civil unrest. I mean, they're not saying it's going to happen, but they're preparing for
Right.
it, and it was a secret document that was released. So yeah, I know what you're talking about there.
Yeah, so that's good to get confirmation from you, but Adam's a very good source, so it made sense. But just it kind of all fits within, as you and I've talked about before, this Neil House fourth turning is here thesis. And the fourth turning is a mega crisis that comes along about once every 80, 90 years. Our last mega crisis, of course, was the Great Depression, World War II. Before that, the Civil War. Before that, the Revolutionary War. Before the Glorious Revolution. It's a cycle that just keeps repeating, goes all the way back to Roman times. So if that's happening, and I think it is, and I think all you'd have to do is just look around each day to see this major, kind of crescendo of problems that are hitting us. And I would argue the most acute is the what I've called with you before, the federal fiscal funding fiasco, my 4F scenario. And what happens when you get into a recession and the government during good times has been running these massive deficits. That's not what you're supposed to do. Keynes said in good times, government should run surpluses, pay down debt so they can take on debt and run big deficits in downturns. And, we're ignoring that advice. And I think to our great risk. So yes, I worry about that tremendously, that we could have, this election that we have coming up could be, could lead to that, could lead to something that is almost a kind of a stealth civil war. And this tremendous bifurcation that's going on between red states and blue states, and the red states, just fact of the matter, economically, they're doing a lot better than the blue states. The blue states are losing their tax base, and it's kind of a death spiral. And then they try to raise taxes more, and then even more of a outflight and outmigration. So that's why I would loop back and say, if you're a conservative investor and you want income, these emerging markets that, for the most part, don't have these issues are actually, instead of being viewed as riskier, I think they're less risky. And that's a very different situation. But again, Jay Powell was saying that just the other day.
Mhm. Let's close off on this note. Interesting thoughts here. You mentioned that your fund generates yield. It's one of your primary strategies. So besides commodities, which we talked about, how else would you do this?
Well, we still think corporate bonds look okay. I mean, the negative is the credit spreads are very tight. This is extremely different than it was in the summer and fall of 2022 when we were buying these guys hand over fist. And frankly, a lot of those have generated equity-like returns because they've appreciated on top of their good yields. I mean, some are up 20% in price. So maybe not quite as good as the S&P, but pretty competitive, certainly better risk adjusted. You can still get 5.5%, 6%, and don't have to go out too far. Some of the hard asset based like royalty trusts.
You're talking about a high
have a
grade
place to
corp.
be.
You're talking about high grade corporate debt now, David. You're not going to the junk bond territory.
Well, we actually like to use an oxymoron more on high grade junk, double B,
Okay,
because double B has very historically very low defaults even during the Great Recession.
sure.
And they tend to, and we try to focus on the stronger ones, and oftentimes they get upgraded. So it's nice to go from double B to triple B because you get a price bump. But I would still say it's not as attractive as it was certainly, a year and a half ago, 2 years ago, year and 3/4 ago. So it was really the summer of 2022, and these things hit bottom, and the spreads got up to plus 600 on high yield, and right now they're about, I think, under 400, and on investment grade they're only 200. So but the overall rate levels are up a lot, so it's kind of like that's bad, but the overall rate levels are good. So it's I think it's appropriate to have a cash reserve. I'm afraid a lot of investors are overdoing it on the cash reserve aspect, and they're going to be disappointed when rates do start to come down.
Yeah. On that note, cash reserves going up. That's that's not the first time I've heard of it. Warren Buffett's doing that, by the way. Berkshire Hathaway just
Oh,
huge
tons of
cash.
cash.
Yeah, you know about this, right? They more cash in the history of their company than ever. So that's
So it's telling you he's having trouble. He's having trouble, allocating capital. He's not finding great bargains. The rumor is he's going to buy out Chubb. He's got a position in Chubb, and Barron's was speculating he'll take a big chunk of his cash and buy it out completely, and it only trades at 11 times earnings. I mean, there's always pockets of value, so don't misinterpret me. We actually like Chubb a lot. It's broken out, so it looks great on a chart. But in general, it's tougher to find great bargains right now than it was even a few months ago.
is there anything that looks very cheap to you right now?
Well, I will go back and say I think emerging market debt looks very cheap, and how many people have it? Hardly anybody in the West. I think the gold story is a good one. I think particularly the miners have lagged. I'm quite intrigued by Newmont. Again, it's run a little bit here lately, actually quite a bit from the bottom, but I mean, it's still way down from where it was a couple of years ago. And it's the only gold mining stock in the S&P. So if institutional investors finally wake up and go, gosh, we got to have some gold exposure, that one could really get a big bid. So I would like it, but just on the caveat, it might pull back a little bit here after the run it's had. But
Okay.
it's still quite cheap.
Final
And energy. I mean, the energy stocks,
energy.
there's a
Yeah.
lot of energy stocks that look terrific. And I do believe that oil is going much higher over time. Natural gas, which I stuck with when everybody else was bailing on it, has been, no pun intended, on fire lately.
Yeah.
But names like Apache, APA, that looks so cheap. Helmerich and Payne, which is the premier horizontal driller in the Permian Basin, that stock looks extremely cheap and it's pulled back here lately. So yeah, there's definitely still some places to make money.
Oil's pulled back from
Suddenly,
$86 a barrel. Is that because of reduced geopolitical tensions, or what's going on there?
I think so. I think there was a little bit of the, what if the war becomes more, involves more parties in the Middle East, but really, I think you've had this tremendous dumping of oil onto the market by the Biden administration, and most people tend to look at the IEA's inventories, and the IEA has been horribly off the mark for decades on their oil demand and supply forecasts, even retroactively, and then they have to do these massive revisions, kind of like what I was talking about with the jobs. And they're once again telling the world that, inventories are fine. Well, in reality, if you adjust for the SBR releases, they're extremely low. So you've got a very tight market and you've got this CapEx starvation situation where, frankly, as we talked about before recorded, that most of the CapEx, that's well, not most, about half of it has been going into LNG. We were the world's biggest importer of natural gas. Now we're the world's biggest exporter of natural gas. It's an incredible miracle. And it's going to be like another 7 billion cubic feet a day of exports are coming online, export capabilities in the relatively near future, like next 6 to 12 months. That's about 7% of total demand for natural gas. That's huge. And you've got the loss of the Russian gas. So I think these natural gas stocks, and again, they're going to benefit from this AI thing. People are waking up to that natural gas is going to be one of the biggest beneficiaries of the AI-induced electricity surge.
Yeah, yeah, that is a narrative I've heard. All right, finally, so Bubble 3.0 is a piece of work that you've published. It's on your Substack, I
Thank you.
believe.
Thank you for saying piece of work and not something else.
Uh, it's a it's a great piece of work. It's I don't know if I would call it a book because I don't think it's a hard copy, right? Is there a hard copy version?
No, there are hard copies.
Oh,
If
there
you
are.
guys want to just
Okay,
email me, we'll send it to you. But it's an audio form. You can download it off of Substack or Haymaker dot Substack. So it's there. But yeah, I mean, if anybody listening to this has got a good publisher that wants to publish a book about this, plus the coda to it, the follow up,
I got
because I
your
really do think we're getting, kind of bubble 3.5, with this kind of echo bubble that we're going through
that
here
is
again. And
my
just look what happened.
yeah.
Go ahead.
That is my question. By the way, I got your Bubble 2.0 book, so that I know that's a book. I wasn't sure Bubble 3.0 is a book, but yeah, 3.5. If you had to go back and revise 3.0 and to make it 3.5 because everything's going up, like we said, what would you add to that list?
So what I would talk about, in fact, I'm already starting this in our newsletter, this series called The Great Disconnect. And it really is kind of along the lines of what Ray Dalio was saying, is that we have, one of the most overvalued stock markets in history at the same time that we've got these existential threats rising to a degree that we haven't seen in 80 years. It's just nonsensical. I mean, something's wrong. Either we're going to get just like a series of great breaks, maybe an energy productivity miracle that would be far better than the shale revolution that happened. But it's unlikely that's going to occur. So something's going to have to give. And I think what's going to give is this euphoria and complacency in the equity markets and the realization that some of these problems aren't going away. They're going to actually intensify unless they're properly dealt with. And there's just, like the deficit. I mean, there's just no impetus. There's no motivation or push in Washington to try to get these deficits under control. And that's, I say it's one thing when you do that in a downturn, but to be doing that during an expansion it's unheard of. So it's a dangerous time. And so that's going to be really, that is the main theme of call it bubble 3.5 is, just look what happened with GameStop here in AMC last week, where these meme stocks all of a sudden exploded again in price, even though their fundamentals are terrible. And there's so many, we talked about this last time, that I don't think the risk so much as the Magnificent Seven, which is maybe down to the Magnificent Four or Five, but it's this level down. I know I brought up Wingstop last time, 150 times earnings, and Carvana, which you could buy either AutoNation or Lithia 4 times for the valuation of Carvana, which all it does is, it's barely making some money now, but it's just generated billions of losses and has a terrible balance sheet. And there's a lot of crazy stuff going on in those names right now. And I think that's where there's going to be, once again, huge losses.
I wish I could just buy an inflation index and hedge against my own life. That's what I would do. but you've got some better ideas than me. Where can we find your work, David? I mentioned you have several books and a Substack. Tell us where we can find those things and anything else.
Well, again, yeah, Substack, Haymaker dot Substack is where you can find our like our newsletters. We write 2 newsletters a week. A decent amount of that is free, but we do put our most important content behind the paywall, and particularly our trading ideas or trading suggestions. We don't make official recommendations. We just kind of highlight things, and sometimes we can make recommendations with asset classes. That's easier to do with it than with individual names. And also just go to the Evergreen Gavekal website. That is my day job as co-chief investment officer along with Jeff Dix. And we're especially proud of what we've done for clients on the income front.
David, always great catching up with you. Thanks very much for your
Thank you,
time.
David.
And I hope you're
Well,
enjoying better weather than myself today. Uh,
not much.
not much.
It's going to be raining hard here in a little bit.
All right. Well, stay tuned for next time. Thank you very much again, and thank you for watching. Don't forget to like and subscribe and follow Dave in the links down below.